Welcome to Money Matters TV. My name is Paul Mitchell. I'm a commercial banker. I'm your co-host for this show. Together with me is Michael Donahue, CPA.
Oh, Paul.
Is the other co-host. Michael, thanks for joining the show.
Oh, thanks for having me.
You're with Ducker and Scaccetti, I believe.
That's right, yes. We're a CPA firm here in the city, 16th and Market. Our customer base is closely held businesses and their owners. So we try to help them with financial and tax issues that they have. And, you know, right now, this seems like the biggest questions people have now are about proposed tax legislation. But, but there's always underlying business issues in all clients.
Still, a lot of that's up in the air, right?
Up in the air, yeah. Getting more closer to finalization, but yeah.
So you work with a lot of small businesses and maybe a lower middle market type of
situations? So I would say, what we don't do is public work. So we want to do SEC clients, but anything else. So a typical client would be someone in manufacturing, distribution, real estate, professional services, and they would be owned by a family or two. And their issues would be mostly tied to not just tax minimization, but you know, good financing. So relationships with banks are important. Insurance, investments, and you know, how to keep employees growing inside their organization. So compensation matters as well.
Sure. So you mentioned manufacturing. I mean, some people say manufacturing in the U.S. is dead. I mean, I personally don't believe that. I mean, there's been changes and all. But what's your perspective?
Well, we surely don't see it in our client base, that there is growth in our manufacturers. The manufacturing that actually exists, if you look in the footprint of Philadelphia, if you look around some of the places like U.S. Steel up in Fairless, there's still a lot of contractors that were selling into the U.S. Steel plant. You say the same thing about some Navy base operations. They're still in South Jersey and they're still making products. And so there's a lot of what I call contract manufacturers, or manufacturers that were there when their big business was there, and now they're still supplying other. Yeah,
I know a company in the far suburbs that makes axles.
Okay.
You know, they get the piece of cylindrical metal.
Right.
They're going to shave it and machine it and anodize it and whatever, et cetera, and it goes into things like tractors or maybe tractor lawnmower type things like that. So nothing has their name on it.
You really see it as a global market. So it might be part of a bigger piece of equipment, or we might be buying some parts from other countries, and but it still is vibrant. Is it as vibrant as it was before? Probably not. Not as I can remember when I first started in this business, it was extremely vibrant.
And certainly,
but it's still there. But it's a different kind of manufacturing. It's much more technology.
Yeah, I was going to say, in certain industries kind of have left the area, like apparel, textiles.
Sure. Yeah.
That Philadelphia was just huge.
Yeah, you remember Lehigh, Broad Lehigh area?
Yeah. You still see some of the signs there with Stetson or this and that and whatever.
Yeah.
You mentioned also about financing. You help your clients with
financing. So I mean, I know your business is banking, so in our client base, where it is family-owned businesses, another partner in the business is the bank. I mean, because you need the bank to grow, you need the bank to have the company go from one generation to the next with financing. Sure. So your banking relationship, the banking relationship with a bank, is very important to a company. And have you seen much new in the banking world, Paul? Do you see any kind of new regulations coming down the path, or less regulations?
Well, hopefully less regulations. I mean, with the Great Recession, a lot of regulations were imposed upon the banking industry as a broad brush, which frequently happens when things happen. There's a big knee-jerk reaction, and everybody's affected. The smaller banks, I think, had little to do with what happened in the banking industry disaster type of thing. But they ended up being subjected to the regulations of some of these huge banks that just were a mess.
Yeah, one law fit everybody at the end of that.
Exactly. So because of the ups and downs in the banking industry, for example, there's been a growth. It's significant. It's not maybe huge yet, but it's sort of significant of non-bank financing.
Oh, what's that, Paul? What is that?
Well, some of these things on the internet for small businesses, you hear advertisements about and stuff. You don't need financial statements, and this and that and whatever. But typically it's for smaller amounts, probably well under $1 million, they don't discuss, of course, the rates they're talking about, but that's a lot easier than dealing with the bank. Specialized services and asset-based lending, for example, there's a lot of that. Even in real estate financing, there are non-banks that provide real estate financing. Some people think they're a steadier source.
What I've seen over the years, Paul, with my clients in banking, a loan that used to take a month now takes 3.
Yeah.
I mean, and that's when it's well intentioned and we know we're going to get there. It's still 3 months.
Yeah, yeah.
There's an appraisal process usually. There's an underwriting process of some sort, and there's all kinds of requirements now with lending. So, I guess the one thing is in the banking world is that when we have those kind of issues with our clients, the relationship is really important. The relationship with the lender is really important because
how well they know the business and people involved in the business is very important. I mean, financial statements are one aspect of it, but the character of the individuals. Have they been through tough times before? Right. How have they behaved in adverse circumstances? Things like that.
Yeah. With our clients, either they're growing internally, but more often than not, they're growing through acquisitions. So the financing is important for the acquisitions piece. Yeah. Sometimes we're looking at small business lending. Do you work in small business lending, like SBA lending?
Oh, yeah, absolutely. Federal. Absolutely. Yeah, it's another good tool.
Is there a certain market that's better for SBA than?
Well, there's certain markets that are very commonly subject to or appropriate for SBA financing. Hotels and motels, for example. So these are industries typically that are not, I'll say, traditional bank favorites. Okay, the motel business can be, have its ups and downs. Franchises is another big area. Wow. With franchises, there's typically not that much collateral. Whether it's machinery, equipment, or real estate collateral, or something like that. But franchises can be a good source of bank business because there's a lot of I guess infrastructure to the franchise. It's not you or me going out and starting our own business.
Right.
There's a way of doing things. There's a success rate. You can look at 30 other or 100 other franchises that have done well in that industry. They have a good name and that type of thing. Right. So maybe you can go a little longer on uncollateralized type of lending. So turnarounds, that type of thing, things that are just not up to the blue chip A plus degree that a bank would typically like to see. So there is another avenue. So it's not a situation for bad loans, but for those that aren't quite as pristine as you'd like. And there's less. The banks typically can make all the decisions themselves now as a preferred lender. Decades ago, it was a lengthy process and ununderstandable documentation and that type of thing, and who knows what was going on. But it's gotten a lot smoother now. So it's something that people should really look at very
again, they rely on the relationship. They just trust the relationship that they have, and hopefully it won't be, won't be harmed during an acquisition or something like that. So that's where.
Well, I guess one of my favorite points is that businesses should be looking at using advisors to their advantage. That is, if somebody is going out, business is going out to make an acquisition and hasn't made an acquisition ever before, or it's been 5 or 6 years, they should go to somebody that has more expertise and listen, have them send them in the right direction.
Sure.
So that's a good CPA firm. That's you have other clients.
Someone that has experience.
Yeah, exactly.
Experience in the ups and downs of acquisitions. Yeah.
So there's a lot to it, but we've got a good guest coming up.
Oh, good. Okay.
And we would like to, but before we get to that, we have a question from the audience.
Okay, let's take it.
And the question is from Rick Carlson of Philadelphia. What can we look for in the new federal tax law? I think that's right up your alley.
That's right up my alley, yeah. So let's just go, I know we only have a couple minutes to talk about this, of course, but but let's just try to bring it down to a couple minutes. This new tax law from the federal government is really the work of Ways and Means Committee and Ryan, the Speaker of the House, for a decade now. He's been trying to get a plan that's simplistic, and that's almost impossible in the tax world, and flat, which we're getting to here. So it's going to be a tax. I think we see a tax coming. There's a lot of talk in the TV wonks, the political wonks, people that they're talking about it, who gets benefited, who doesn't get benefit from this. But it's making it a broader tax where businesses, let's take pass-through businesses, are going to lose some deductions, but they're going to have lower rates. Okay, so and they're going to have less complications. There's going to be not as much alternative minimum tax issues, not as much issues as timing of deductions and whatnot. The bigger corporations, the C corporations, they're going to have the lowest rate that they've had in my career. They're going to go from 35% to 20%.
That's huge.
Yeah, but to fund all this, there's going to be all this money that's held offshore by the big corporations.
That's right,
that will come in and be taxed at one-time hit of 10 to 15, 10 to 14%. And that's going to fund a lot of this bill. So so it looks like, you know, we're making it now a system where you pay tax where you do business. American businesses used to do business overseas and they pay tax in America, you know, and overseas and get a credit for the taxes paid overseas here. Complicated system. Now it's going to be more territorial. If you're doing business in Europe, you pay tax in Europe and bring the money back to the U.S., it's not a tax again. So we're going to look more like the rest of the world, and hopefully that makes us more competitive.
Sounds good to me.
But I mean, there's still, I think it's down to, you know, 10 or 20 items that need to be ironed out, but they will be. So
that's terrific. Well, thanks, Michael. You're great to hear from an expert.
Okay,
that knows what's going on.
Thank you, Paul. Thank you.
So if you would like also to send in a question to Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
And now I'd like to introduce our featured guest for this show, Matthew Silverhardt, CFA. Matt,
nice to meet you.
Welcome to the show. Thanks for coming.
Thank you so much for having me.
Hi, Matt.
Hi, how are you?
I understand you're a financial guy also. We've got 3 of us now.
I know. It's a nice crowd here. We got...
we all have our niches, though. What is your niche, Matt?
Yeah, so... a lot of the times financial advisor, the term is thrown out, and so rather than do that, what we tell people is that we're goal planners. So people come to us, and what we first try to do is, rather than go into the weeds on a specific strategy or talk about focus on investments, which tends to be more the kind of like the latter stages, it's what is the goal that you're trying to accomplish. So if it's retirement, we try and dig a little bit deeper, try and find out, okay, well, what are the expenses that you're going to look for in retirement? When are you going to retire? When might you slow down? Is there any family history we should know about so we know how long we need to try and have this income stream provide? So establishing the goal in large part is a big part of what we do, and refining that throughout the process of dealing with clients over time is why we have that kind of ongoing consultation with our client base. From there, it's what are the strategies that need to be considered for the goal in mind. So you have, with retirement, when to elect Social Security, how to take elections from deferred compensation, what should my asset allocation look like with my investments, what tax planning may or may not need to be factored in and at what time. So it's a pretty dynamic relationship we have with our clients, and so from a goal perspective, it can be applied to a lot of different things: retirement, education, buying a shore house, whatever.
Matt, I see that you're with Ameriprise as well, right? Is there what is the difference? Is there a difference with that, with being with Ameriprise, or? Well,
so we're an independent franchisee of Ameriprise, so we operate pretty much independently of Ameriprise, though we do kind of hold our shingle there. But with regards to the planning that we do, I can't think of much that's tied to Ameriprise other than when you go into your statement, you'll see Ameriprise as your broker-dealer and so forth. But one of the freedoms we have is to be able to operate independently, and as fiduciaries with regards to the planning that we do for our clients, I think that's obviously really important to give us that flexibility.
Matt, how'd you get in the business?
Good question. I don't remember. No. So I got in the business 14 years ago, started at a different company. It was actually someone who I had met in kind of networking, and just got my introduction that way. Always had financial discussions with family members growing up, and my father was always talking about the markets and still does to this day. So I always had a little bit of an interest to it. I think now the evolution is the psychology of money interests me the most in the context of how we deal with our clients. But it's been a process to where it is today.
So we're in the middle of a market now that seems to be really great for equities. It seems like there's a great. Is there a behavioral side to this? Do clients start thinking that tomorrow is going to be just like yesterday, and we're going to have these great returns? Or
yeah, so great question. So yes, the answer is behavioral biases. I think have, in my opinion, tended to be one of the bigger pitfalls that a client can, or a non-client can walk potentially into. So particularly after a long expanded market upswing, which we've had, which everyone cheers, and why wouldn't you? The discipline process really does need to come back into focus in the context of your plan, but specifically with regards to two biases we see right now. So you basically have cognitive reasoning issues that some people may have, and this is applied to a lot of people. So think of that as belief perseverance, conservation bias. I only read articles that I don't read anything that has anything to do with, if I'm a stock guy, I want to become more aggressive, I'm not going to read why I may want to own bonds. Confirmation bias is only reading stuff that confirms that. So that can sometimes lead to faulty reasoning of how I should be invested, and obviously we try and guide people away from not only looking at one side of the coin, and looking at research on both ends is a good solution. The harder one, though, is emotional biases, and these are things that everyone's different. But the big ones right now, and I think this is understandable, is hindsight bias, which is the idea that we knew this all along, that the market would have recovered from where it was to the heights that it is now, and everything that has happened since we knew. And so it can lead to sometimes a false sense of confidence, which can lead to maybe a little excessive risk-taking. We see it, we read about this anecdotally. We try to make sure clients are aware of that when we talk to them. I think the big risk for those that sometimes don't deal with advisors, or we try and make sure we hone in on them if they are our client, is that's hand in hand with the biggest one, which is loss aversion. So if you've been making money for the last 8 years, almost 9, and not to say it becomes a complacency, but there is a little bit of a lack of satisfaction. Okay, I made more money every year. It's it's kind of an accustomed thing, and so that satisfaction wears off. But the minute you lose money, it's actually known to be a lot more painful immediately, and so that loss aversion is, oh wow, I've lost. And it can sometimes paralyze people's decision-making skills. So if you compound that with taking extra risk, those are recipes that you may see and read about why people may have done the wrong things at the wrong times, and that's what we try and make sure you not do.
So it sounds like an investor can be a risk taker to some degree, yet when there's a loss verse, like it actually doesn't. They should be playing together, but. The reality is they don't want the loss, right, at the end of the day, even though they're risk takers, right?
Yeah, I mean, we're not robots. So at the end of the day, as humans, behavioral modifications or portfolio modifications to our biases, we absolutely factor in. And our job is to understand the client. Everyone is actually different. There are things that are more objective. How far are you from your goal? The further away, all things being equal, the more risk you can take. But as it pertains to the stomach part of your ability to take risk, everyone's different, and our ability to make sure that we understand that fully allows us to make any adjustments that allow people to stay the course, because that's what needs to happen for someone to have the best chance of success.
Right.
How should people view their portfolio in the context of their job?
So another great question. So there's a book that's called "Are You a Stock or Are You a Bond?" And I think, just to kind of summarize where we're at with your question is, if you look at your investments and you look at your financial capital as one type of bucket, you also should be cognizant of what it is that you do for a living, if ultimately you want to balance those two out. So if I am a young physician, just as an example, tends to be a less inelastic type of job. Your income tends to be a little bit more steady. And so you could be thought of as a bond-like type of position because your income is going to be rather steady over time. So if you wanted to, for example, be a general aggressive person, it would certainly make sense to be generally pretty aggressive with your investments if you wanted to balance those two out, being that your job is rather conservative in terms of how you make money. On the flip side, and there's a lot of people on the other end of this where their jobs are more cyclical, and there's a lot of different ones, so I make an example of it. But if you are trying to be moderate, and this is sometimes where you have to kind of think through this, but if someone's income is cyclical, even if they are young, it may argue towards having a more balanced portfolio than you might not, or you might otherwise not have done to try and keep the whole thing together.
Point.
So those things are, I think, allow people to, if you think about it, withstand a downturn. Because if a downturn happens, your investments temporarily go down and your income suffers, that can sometimes be a not fun place to be.
There's more and more discussion about robo-advisors, and I don't know what that is. Maybe you could explain it to me and where they fit in, if they do. I don't even know what they do.
Yeah, so they're just robots. No, they're just, they call you up. No, so a robo-advisor is it's just another term. They've been around for years now. And so I think the term is more of an automated process where, and where I see it fitting is do-it-yourselfers that have already, done things, on their own, now have access to more automation with regards to certain things that you should do as a financial, within your financial life. So rebalancing your portfolio and things of that nature for a do-it-yourselfer have become easier with a robo-advisor.
What are the risks of dealing with a robo-advisor?
Right, so the risks, I think, are that, and we'll see, but when we have another downturn and there actually needs to be a conversation to stay the course, a robo-advisor will be great to make sure your portfolio is balanced properly. I think it remains to be seen the ability for the client to actually, without a conversation in the context of other life changes that factor in, okay, am I, did I lose a job? There's just a myriad of things that can happen. Am I having another child? All those things factor into, does my portfolio need to tweak a little bit here or there? So with that being said, I mean, it's a lot of the robo-advisors will offer consultation. I don't know how intimate it could possibly be, but it's just something at the end of the day that for advisors that are not robots and actually meet with our clients, I think it's a net benefit, because at the end of the day, we're comprehensive planners, so we've, in our opinion, kind of been a little bit ahead in that we're looking at things integrative, where if you were only doing investment work or only doing insurance work, a robo-advisor might be your worst nightmare, because they're effectively automating something that, if you're not doing things integratively, that could be a little bit of a challenge. So it's raising the game for advisors.
I see.
I noticed in your business there you got some jargon. You got some ALM, asset liability management. In the banking industry, we have AML.
Okay.
Which is a big deal.
What does that stand for, Paul?
Well, it's big banks that have paid hundreds, if not billions, of dollars in fines for AML.
Oh gosh, let's hope it's not that.
Anti-money laundering.
Okay.
So banks must be very cognizant of their anti-money laundering programs, because if they're not, the feds will fine them billions of dollars, which they have.
Sure.
But ALM, that's a little more positive sounding. I hope.
Hey, yeah.
Yeah, so it's I get a little nerdy jargon, but yeah, so asset liability management is really the idea of, with regards to what we do for our clients, is looking at what goals you have in mind. And this, I don't want to say it's a positive thing, it's just there's a positive aspect to it. It's a liability. When you're retiring and you think at 65 you want to retire and you need X amount of dollars for 30 years, at the end of the day, that is a liability that you need to save against.
Okay.
To be able to...
It's an outflow, yeah.
It's an outflow, exactly. So the liability needs to be matched with the asset. And so certain elements of your expenses when you're retired may have more of a fixed component, which means that some of your assets can be paid out in a more fixed component. Think of Social Security, certain bonds, whereas there are more inflationary expenses that lie within people's expenses that sometimes need to be matched with equities. Sometimes the bigger point, and this is the positive spin, is a lot of the focus is always on the asset accumulation, which it should be for people to be able to reach retirement. I think sometimes what's not always talked about is, well, you could also give yourself a great chance of retiring by lowering the liabilities, which are, can you cap the inflation on some of the expenses going into retirement? An example would be people that had put on solar panels that may have lived in a state with high electricity costs. And so before, you would have to maybe say, okay, well, your electric bill is going to be X amount of dollars, but it's going to grow by inflation over 30 years, and so that's going to cost you this amount of money to save against. Well, you get solar panels that should help to mitigate a lot of that inflation risk.
Yeah. Matt, it sounds like you have a lot of great ideas. So if somebody, one of our viewers or a lot of our viewers would want to contact you, how do they do? Do you have a website or?
Yeah, so you can search for my name, Matthew Silverhardt.
How do you spell Silverhardt?
That's a tough one. That's Silverhardt.
Okay.
We're right here in Philadelphia, 16th and Walnut. Also out of Doylestown a couple days a week. But yeah, we're right on the web there, and yeah, so it's a great conversation. Every one of our clients, and we're kind of lucky to have clients, and I guess it's a match that you have to make sure you make, is it's a pretty intimate process. So fortunately, the people that we're working with, generally speaking, it's a long-term relationship, and you tend to you realize these are relationships, they're not clients. So it is cheesy, but it is the truth. There's a lot of people that we genuinely care about.
Well, one thing I recognize you have a passion for the business. I mean, you started when you were a young person,
right,
at the family level, and then got into it and followed it. So it kind of reads through. It's a great story, Matt. Really appreciate you coming in and joining us for the show.
Thank you so much for having me. I appreciate the time.
You're welcome. Pleasure.
Thank you so much.
Okay.
So thank you for watching the show, and just want to have you all remember one thing, that your money matters. Now, our next guest next time will be Terry Doherty, who's Executive Director of Philadelphia Rowing. Thank you again.